Today's interest rate cut is both good and bad for the economy. I'll tell you why in a bit. Today on December 11, 2024, the Bank of Canada BOC reduced its benchmark interest rate by 0.5%. That brought it down to 3.25%. Basically, the overnight lending rate right now is at 3.25%. Many people will take that as great news. In this video, I'm gonna tell you the both sides of it, the good part and the bad part about it. Just so you know, this was a huge step by Bank of Canada in order to stimulate the Canadian economy. As I said in this video, I'm gonna tell you about the good and bad impacts it's gonna have on the economy and what you can expect to happen in the real estate market. First, I'm gonna start with the positive impacts. First one is stimulating the economic growth. Lower interest rates reduce borrowing costs for consumers and businesses, and it encourages spending and investment. This can lead to increased economic activity and job creation, hopefully. The second positive impact is relief for borrowers. So those individuals with variable rate mortgages or loans may experience reduced monthly payments, which would provide them financial relief and increasing disposable income. The third one is that it's going to boost the housing market. So lower mortgage rates can make homeownership more affordable, especially for first-time homebuyer. It can potentially increase the demand in the real estate market. In Toronto, it could lead rebound in home sales, and it's going to support property values. Recent data indicates that home sales in the Greater Toronto have been rising. And if you have been following my YouTube channel or you have been watching my videos, you know that the amount of inventory is dropping in most property types in the city of Toronto. That indicates a higher demand basically coming back to the market. So now I'm going to talk about the negative impacts. The first one is that it's going to encourage excessive borrowing, which is not good. Lower interest rates might lead consumers and businesses to take on more debt that they can manage, increasingly financial vulnerability, especially if the economic conditions get worse from here on. The second negative impact is it's going to increase the chances for asset bubbles. Prolonged lower interest rates can inflate the asset prices, including real estate, leading to unsustainable price levels and the risk of a market correction. The third negative impact is its impact on the savers. Reduced interest rates can lead to lower returns on saving accounts and fixed income investments, affecting individuals, those individuals, of course, who rely on interest income. The last important negative impact is that it can devalue the loonie, the Canadian dollar. The Canadian dollar will lose value over time if this continues, and that means higher prices for imported goods and services, and literally things will be getting more expensive. So I'm gonna elaborate a little bit on the impact on Toronto real estate market because this is the market that I work in. So as mentioned earlier, lower rates mean cheaper mortgages, which could basically make homeownership more accessible and drive up the demand. That's good news for sellers, investors, and current homeowners as prices might rise. But for the first-time homebuyers, this could make affordability even tougher if prices climb up too fast. So on the flip side, cheaper borrowing could lead to bigger mortgages, increasing the household debt. If rates go back up or the economy slows, that could spell trouble for overextended buyers. So if you're thinking of buying, now's the time to assess your finances and plan carefully. This rate cut is all about stimulating the economy and it might bring more activity to the market, but with the risk of rising prices and debt levels. Toronto real estate scene is still a mixed bag. Make sure to subscribe to my channel to stay in the know. Use the link down below to book a meeting with me if you have any questions on Toronto real estate market. See you next time.